Hey everyone, welcome to another day of the Financial Coconut Daily. So I'm your host Chung Soon, and joining me is my co-host Andrew. And our
Hi.
guest today is Adam. Welcome, Adam.
Hi. Thank you. Thank
All
you for
right.
having me.
Yeah. No, thank you for joining us. So just a few things to clarify before we begin. Things that we'll be talking about today is just purely for entertainment purposes. Please, if you have any questions or comments or anything, leave in the chat box or the comments on Facebook, and we will definitely be able to pull it up and ask Adam on your behalf. Besides that, this is probably going to be our last daily for this series. Hopefully, right? Fingers crossed that Singapore does not extend its lockdown. So yeah, thank you all for joining us up to this point. And so let's just dig right in.
Hey, so the last time I interviewed Adam was about 10 years ago, maybe a bit longer than 10 years. So back then I was profiling young, successful people, and Adam was one of them. So he's achieved success at quite a young age. And back then, Adam, you made your mark in internet marketing, right? And after that, like
right.
you got into other areas, you published a book, you found this company called The Fifth Person. Take us through your journey.
Yeah, so I think I met Andrew, I think it was, 10, 15 years ago. So we've come a long
Was it
way.
15? Oh, man.
I think so. I don't know. I feel a bit old today. So
I think it's 15. I think it's 15. Oh, no. I
I
actually
think it's 15 years ago. I think
miscalculated. Yeah.
I was in my mid-20s. I'm almost 40 now. So yeah, a lot has changed. And yeah, so I started the fifth person, I think 7 years ago already. Time flies. And if you go to our website on fifthperson.com, you have a lot of free articles and analysis on basically stock investing in Asia and the US. So what we do is we provide, our opinions, our analysis, our research on the stocks that we are looking at, and we share them with our readers as well. So all of that is free. We cover a lot of REITs. We go to AGMs, Singapore stocks, dividend stocks, and of course, a lot of the growth stocks in the US as well. So that's what we do at this point. Yeah.
So back then when I first met you at 15 years ago, were you starting out or were you already in the market? Like, where are you at in terms of investing?
I think when I first started out, it was in internet marketing. So back then, the internet was a pretty much very different place from where it is, what it is right now. Right now, it's pretty much like a pillar of our lives, right? I mean, you've seen during this pandemic, everything's online and it's going to be accelerated some more. But back then, 15 years ago, it wasn't that central to our lives. So I started with internet marketing. A lot of stuff that I picked up then was about basically how to reach out to people online, how do you connect with them, how do you share your message with them, whether in whatever business you're doing. So I picked up those skills in internet marketing, and I ran a bunch of sites. Uh, and then I've taken those skills and applied them to my business today in the fifth person today. I'm a lot more in the editorial space nowadays. I'm the editor of of where I am right now. So I focus a lot more on content and stuff like that, less so marketing. But it's kind of there's an overlap as well. And back then I hadn't started investing. I think it was 2005 or six. I hadn't started investing. I was still in my 20s. Didn't have a lot of money to invest in. So I invest a lot more nowadays. Yeah. So it's been quite a journey since.
Right. So Adam calls himself the editor-in-chief at The Fifth Person. So, I mean, you also shared that you're not doing so much of marketing right now, but more of content, editorial, and also running classes and seminars. Is that correct?
Yeah, so I mean, a lot of the stuff that you can find on our site is just it's pretty much free. You can pretty much pick up a lot of skills and best practices about how you can invest, how you can manage your money, how you should go about analyzing a business. All right, but for people who want kind of like want a framework from A to Z, how do you do all these steps put together in one convenient place, along with all the explanations and the videos and the steps. We have courses for that. So we've pretty much focused on two kinds of investing because that's what most Singaporeans, because it's where we're from, right, are interested in. So one of them is pretty much dividends. Whenever I go to an AGM, you always get a question about dividends. There's uncles and aunties always asking, how come my dividend isn't higher? So Singaporeans love dividends. There's one type of investing they are very interested in. And the other kind of investing is in growth stock. So you want to invest in the best companies out there, like Amazon, Apple, Google, Facebook. These are big names that we all know. They operate in the US and pretty much globally, actually. Even though they're American companies, their footprint is global, and their ceiling is so high. So these are the two kinds of kinds of investments that we look at. So we have two courses. One is dividend machines for dividends, and there's one called Investment Quadrant where we focus on value and growth investing. So we're actually launching Investment Quadrant next Monday because we only open it about once a year. But yeah, these are the two courses that we have.
So what challenges did you have to overcome in this business, in your opinion? And what do you think of the financial education? I would classify the fifth person as part of financial education space in Singapore. Like, what do you think of this whole space?
Yeah, when we first started 7 years ago, it was a very different scene from what it was now. We launched our website in 2014. We started the company, I think it was January, so it was like at the very start of the year. So back then, there wasn't a lot of info. I mean, there was a lot of information in the US, okay, but in Singapore, a lot of information that you wanted to look out for would be in seminars. So if you wanted to learn something about investing, you would have to go to like a $2,000, $3,000 seminar. It's pretty expensive and it's a huge risk, right? If you don't learn anything, it's a lot of money out of the pocket. So it wasn't democratized like the way it was in the US, where there was a lot of information that was readily available. So we were one of the first movers in this space back then, like 5 to 7 years ago. Nowadays, you see a lot of websites, a lot of blogs, a lot of people sharing, talking about investments online. So the space has really shifted and evolved over the years. And it's the SGX itself has also kind of like acknowledged this space. So I think 3 years ago they launched like an award for like content that's produced, in the online space, and that just tells you that even the establishment is looking at this new area, this place called new media, right? So that's where we started. It was really tough when we started back then. So I remember my first year doing this business. I think probably I don't know, $600 a month as my salary or something like that. And there was no guarantee that the business would work. So there's so many things that I mean, whenever you start a business, there's so many question marks. You don't know if it's going to be successful. You're figuring out things along the way. But when we started out, our mission and the vision was pretty clear, and it's still pretty much the same as it is today, which is to help people make better investment decisions for themselves through the articles and the information that we share. So that's what we do from then till now, every single day.
That's really, really cool. So you mentioned like, when you first started you were saying something about like making about $700 a month, right? How did you know that it was like, okay, this is something I want to do, and I'm going to actually go, full time, not work some other job to kind of make ends meet. And that's part one. And the part two, how did you decide to work with the team that you have today, right? Because you guys are, I'm assuming there's 5 of you. You're calling yourselves a fifth person. So yeah, what's the story there?
Yeah, so the short answer is we started with five of us. There's still 4 of us left today. So I think the two questions are kind of linked. Why did we start this business, and the partners that I have are pretty much the reason why we decided to do this whole thing and why we stuck around for so long, and I think brought the business to where it is today. The fifth person and all that. So when we started this company, we were all investors at that point in time, and we realized that there wasn't a lot of, like I said, information that was readily available for Singaporeans to learn how to invest online, right? Everything was in the seminars and all that. So we wanted to do this business. We felt that we had a mission to share, what we knew, what we were doing. A lot of the times we were just reading the annual reports ourselves, attending the AGMs ourselves, just to give us the research as investors ourselves. And then we just wanted to share the information with people who just wanted to read about it. So that's how we started. And if not for my partners, I don't think I would be here today. I think a lot of the credit goes to them as well. All of them have been tremendous in just pulling. Everyone's pulled their own weight over the last 7 years. They've been tremendous, and We all play very important roles in the business, and yeah, I think all that we've achieved is because of them and all the readers that we have as well. I think we wouldn't be doing all this without them. Yeah.
So I always get the idea that, well, correct me if I'm wrong, but well, because there are four of you, and then the fifth person is the person reading the article or watching on YouTube video. So
Yeah,
we kind of, that's the idea.
there's a pretty interesting story. So yes, the company's name, the fifth person, wasn't because there were five partners at the beginning, but that's the short answer when we give. So if someone asks, you say, yeah, there were five partners. But then one of the partners left to do his own business. He's doing very well as well right now. So there was one networking event that we were with the SGX, and then I think it was I think it was the president of the SGX actually. He was asking us, how come why is your company named the fifth person? Do you have five partners? And I said, no, we only have four. At the time we had four already. Oh, so I guess the fifth person is the reader and someone else, So yeah, that's true. So that he pointed that out, and I thought that was a really good highlight that he made. And nowadays, whenever we kind of host this roundtable on YouTube as well, and there are four of us. And yeah, the fifth person is the person joining us for those discussions and the things that we're talking about. So I think that kind of stuck, and it's all because of the president of the SGX.
Kudos to him. So today we kind of didn't fulfill the idea of fifth person, right? Because there are three of us, and the fourth person is the one that's watching this video. The fifth person is the friend that you share this video to. So take this time to share this video, whether you're watching it on YouTube or Facebook. All right. So bring on the fifth person into this live stream.
Well played, Andrew. Well played.
Right.
So Adam, I guess you guys started 6-7 years ago, and you were saying at that point there was really no the information wasn't democratized, right? And now I would say it seems like everyone is trying to share something or another, right? And this whole world of being an influencer exists now. Is this something that I guess you yourselves are also looking at, like becoming yourself, like building out, like we're going to build our own personal brands to help grow the fifth person, or how have you thought about that type of thing?
I think we were fortunate that we were one of the first movers in this space in Singapore anyway. So that gave us kind of like a head start in the sense that we were one of the first few to kind of like do this. Nowadays, there's so many, but I think that's a good thing as well, because that kind of shows that this industry or like the average person in Singapore is very much interested in learning how to manage their money, how to invest, and they're looking for information online. So that's only a good thing for us. And I think the trust that we've built over the last 5-7 years is really important. So a lot of articles that we have online that we published maybe 5 years ago, they're still being read and shared around. So we just want to make sure that everything that we put out is something that we believe in, is something that if we were to share this information with like our father-in-law and tell them how to invest, this is the stuff we want to share with them. You don't want to. You're not. It's not for marketing or like anything like that. This is just pure investing stuff, and this is stuff that we use ourselves. So that's the philosophy that we live by, and I think that's built up the trust over the last 7 years, and people trust what we share with them online.
Okay, so Adam mentioned that they do a roundtable. It's on YouTube. It's all free content. Over here at TFC, we have podcasts mainly, and today we're doing this live stream. So like all the new media is coming up, and COVID will have affected the way you deliver your courses, right? It's more online nowadays.
Yeah, so we kind of had we had kind of like a hybrid model. So we wanted to move even 7 years ago. We wanted to move to an online model because based on my background in internet marketing, everything is for me to just do it online. It's a lot simpler. It's a lot more convenient, right? And then COVID really just kind of like just like forced everyone to do it. So when the pandemic hit, we were forced to kind of like we did some of our workshops live, and we had a portion that was online videos as well, which you can refer to and reference anytime you want. So we had this hybrid model, But when the pandemic hit, we were forced to stop the live, workshops and move everything entirely online. So I think it's something that all of us have just gotten used to, and there wasn't really much of a shift for us because most of our business was already online.
Okay. So, well, earlier on, you shared that you all started 7 years ago, and now like we're moving online. A lot of development is taking place. Now, in order to teach people about finance, you kind of need to take a stand. You need to have your own investing philosophy because there's so many schools of thought, right? So, how would you describe the fifth person's investing philosophy?
I think I can sum it up in one very simple phrase or sentence, which is we want to invest in great businesses. That's it. So a lot of times when people look at the stock market, they kind of forget that, they look at the prices going up, going down. It's very exciting. Stock prices just jumping every day. And they kind of get lost in the symbols and the ticker symbols and the stock prices. But behind every ticker symbol and stock price is a real business. And that's what we just focus on. A lot of the times, I don't even know the stock prices of the stocks I have. I don't follow them on a daily basis. In fact, I know a lot more about the business than what the share price is today. I don't. So I think the main thing is we look at the business of what we're buying. Because if I share an analogy with you, when we buy a house, we really take the time to go to buy a house, right? You're looking for a home, you want to make sure it's in a good neighborhood, it's convenient, a lot of amenities nearby. Maybe it's near a good school. You want a high floor, good feng shui and stuff like that. You take your time to really buy something, because once you buy it, it's not so easy to sell it. You got to hold on to it, I guess, for a few years or more. But then when it comes to stocks, because it's so liquid, you can just get in and out. People kind of forget that you're buying a business and it becomes a casino, right? But if you use the same approach to buying a house, to buying a business, you kind of like you shift your paradigm and you start really asking yourself, if I really wanted to buy a business and I couldn't sell it for the next 5 years, what would you really buy? Or if you wanted to buy something for your kids and something that they can hold on until they turn 21 or something like that, what kind of business would you buy? And then you really start to focus on the really, really good businesses that you really just believe in, and they will be successful for the next 5, 10, 20 years down the road. So that's what we look at.
So what I'm hearing is a lot of value investing, business fundamentals. So meme stocks are not your thing.
GameStop, that's really interesting because one of us here actually bought GameStop and he did really well with that one. You can actually check out a roundtable on that. If you go to our fifth person channel, we have one roundtable about GameStop, and Kenny, who's our analyst here, he actually invested in GameStop when it was $3. It was a tremendous investment for him. But I think the thing about GameStop is, if you invest in something like GameStop, you got to understand what is your investment thesis behind investing in the stock like GameStop. So if you invest in a company like GameStop, it's a turnaround situation before the short squeeze happened and everything. And you're banking on the fact that GameStop would survive because of the new console cycle that's happening, PlayStation 5, Xbox, and all that, and that would tide the business over the next few years. And then there's a turnaround with the new CEO coming in, and you hope that the business will do better. But over the long term, GameStop is in a tough industry because everything is shifting online. As a gamer myself, nowadays I kind of like just download my games instead of going to a shop to buy it. All right. Sometimes I still buy the games that I like, that are really special to me. I want a physical disc, but if not, I'm just buying it online. So GameStop has a lot of headwinds in its industry. All right. So you need to understand what the situation it's in, what the industry is facing. And then if you decide to invest in something like that, you need to be aware of the risks and what your play is. So GameStop wouldn't be a value investment. It wouldn't be a long-term play like Google or Amazon, stuff like that. It's totally different. So to do something like that, you need a lot more experience, a lot more research that needs to be done, a lot more analysis before you invest in something like that. So it's a different strategy altogether.
Okay. And I guess I want to go back to another comment that you made earlier, right? And you were saying something along the lines of, you know more about the business then you probably know about the share price. How do you get to, so for me personally, like I want to be able to get to that point where like, I don't even know the share price. Like it doesn't faze me. But I was, there's always a part of you that's like, oh, I want to find out what it's trading at or what have you. How did you overcome that, like that emotional roller coaster per se?
I think emotions are part of it. You can't really escape it. It's human nature. When market crashes during COVID, for example, you get emotional. You get emotional either by you're scared that prices will crash some more, or you get really greedy because you want to buy some more, right? So you can't avoid it, but then it just gives you, when you notice your emotions, it's just giving you a signal that maybe you should be paying attention to something. But as you go through more recessions, ups and downs, you kind of realize the emotions are always there, and they don't really change. So instead of trying to like ignore them, just acknowledge that they're there, and then remember that what's your long-term plan when it comes to investing. It's about building an asset base. So by the time you retire, you have this asset base that you can rely on for your passive income or for whatever it is. By the time, when you're 60 or 70 or whatever. So the point is to build an asset base rather than thinking about how you can trade in and out and try to like gamble your way to the top. I mean, some people are really good at that. There's a different strategy altogether, but I don't think I'm a genius. All right. So I don't think I'm that good or that smart. So I'm just going to build my asset base slow and steady. And that's my, what do you call it? That's how I play the odds. Those are how the odds fall in my favor. I'll just buy great businesses and wait for them to just become more successful and more valuable 10 years, 20 years down the road.
Yeah. I want to say I want to follow in your footsteps, but I also know myself right now. It's like it's really hard to overcome that whole like, oh, let's check on it daily or something, right? So something for me to personally work on.
I mean, if you put it this way, do you really check what your home is worth every single month or every single day? You don't, because you just plan to stay in it, use it. Even if you buy a house and you rent it out for passive income, you don't really check what the value of that property is every single month. Or you just kind of like, yeah, I own it. It's my asset. I want to hold on to it. I hope I expect it to appreciate in value over time because I thought I think I buy a good property. You probably only want to check the price when you want to sell it. So I mean, if you have that mindset when it comes to an asset like a property, you have the same mindset you can have the same mindset when it comes to investing in businesses as well, which is the stock market.
I think it all ties in together. So understanding the business fundamentals and we all have this habit of like pulling out our phone to check. I think it's kind of in us, but that doesn't mean that you're gonna sell on the spot when you see it drop, right? But you still want to check.
It's pointless. I mean, if you're not going to sell, then there's no point checking it, unless it's like during COVID, prices are moving all the time and you kind of like just want to check it all the time. But if not, then I just don't bother. I just play my video games or just chill out, watch Netflix or something.
Even for Kenny, who got in GameStop at $3, and interestingly, I said meme stocks, but Adam heard it as GameStop. We realized they all kind of mean the same thing, right? It's like,
GameStop, GameStop was a meme stock as well.
Meme stock, right?
Yeah.
So, but he kind of got in because of maybe his research or his conviction. If he got in at $3, right? I mean, he definitely didn't get in because the hype was already there. No. So I guess the fundamental principle of understanding business still applies. And well, if that's your company's philosophy, I'm pretty sure that will be you and your founders' philosophies as well.
Yeah, of course. So birds of the same feather flock together, right? So, we pretty much have the same philosophy. Maybe there's slight differences in, like for example, Kenny would look at GameStop, right? But I wouldn't. I just don't have I don't want to do that sort of deep research to do stuff. That's not my personality. It's not my forte. He likes it. He does it. And just to bring that up again, we actually published an article about GameStop maybe more than a year ago. Kenny wrote an article about it before this whole mania about GameStop exploded maybe 2 months ago, right? So yeah, we do share a lot of like articles like that on our site. It's all free.
So how would you describe your own investing style? Like, what is the slight difference between you and Kenny?
I'm kind of like pretty boring in the sense that I don't really want to find out the intricacies of so many things that you can bother yourself with when it comes to the stock market. I want to invest in a great business that provides a product or a service that I know I can't live without. If I can't live without it, a lot of people can't live without it. And because of that, they have, you know, it's very hard for competitors to come in because they have a huge economic moat that that protects their business. You can't live without their business. They can raise prices and you still want to use them. And those are the kinds of businesses that we look at. So there's so many examples, like for example, Google, such an obvious example, but I don't think I can live without Google, right? So I use Gmail every day, I use search every day, I watch YouTube. I think without Google, I kind of feel handicapped in some way in my life. So I would invest in a company like Google, and I do. I invest in Google or Alphabet, right, the parent company. So these are the kind of businesses that we want to look at. So uh, yeah, if I put it in that way, these are the things that we want to look at. So it's a great business with something that we can't live without, all right, as wide economic moats, a lot of growth still. And of course, you got to understand the risks before you invest in any company. So you need to understand what are the risks that could affect Google, for example.
So to give us a clearer idea of your style and philosophy, maybe you want to take us through some examples. We could start with Google or some other companies that you have invested in before.
Yeah, let's start with Google. So we when we start with any investment, it's always about the business. So if you understand the business, if you like the business, and you know exactly what the business does, whether you feel completely comfortable with your investment. It's like buying a really good house. You just know it's the best house out there for its location, and whether there's a recession or anything, you kind of know this is still a great asset. I'm going to hold on to it. Of course, there are always circumstances that could change that would make you reconsider that. But in general, you kind of know like, yeah, this is a great business that I want to hold for a very long time to come. So Google is one example. Like I said, they provide products, services that I can't live without, and they almost like have a monopoly on those on search as well. So I don't think anyone here ever uses like Yahoo or Bing to search. Any of you two?
I use Microsoft Edge, and that came with the Bing search. I tried it
Okay.
for what, maybe 3 days. It's like I can't do it. Going back to, and I
Yeah.
just switched the default to
Yeah.
Google.
So you just type in Google in Bing to get to Google, right?
Yeah, it's true. So it's kind of like, yeah, it's just this consumer behavior. We kind of know that. So Google is a great example. They have a monopoly on search. It's even bigger. So they're having a monopoly on desktop, and it's even higher on mobile as well. So when you know that Google is just so dominant in its industry, and they make money through advertising, right? Because they command so many eyeballs every single day. Their advertising business is just doing gangbusters, right? It's just tremendous, um, and it's growing every single year. This trend is not going to stop. A lot more people are going to go online. They're going to search. A lot more people are going to get connected. In developing countries as well, except for China. China has its own ecosystem, right? But around the world, everyone kind of just uses Google. And so when you understand the business of Google, you just don't see how anyone could replace Google at this point in time. Yeah, things could change, but it's very unlikely for now. And people are using this. Are just using their services every single day. And it's so because of people are using it every single day, there's very high recurring revenue, high recurring profits because people keep coming back again and again and again and again. And then when you have a look at the financials, it pretty much tells you the same thing. So, profits are going up, cash flow is going up, revenue is growing. They have very, very low debt. So it's in terms of debt, it's very low risk as well. Um, and all the ratios look very, very good. So the only question is when is it a good time to get in? Because a great company like that doesn't always come cheap. So you kind of wait for the right time. So COVID-19 was a great example of just a lot of great companies were at very good prices. We picked up a lot of companies then, And this is when we invested quite a bit of money at that point in time.
Congratulations on having the guts to step in when I think a lot of people were worried about a lot of other things. But I wanted to learn a bit more about the way you approach position sizing, right? In order for you to actually be able to get in, it means you have to actually have money set aside, which means in the past you had to position your other investments accordingly, right? So how do you have a way or philosophy that you approach that whole idea of like how do you position yourself in, how do you position yourself out of something?
Yeah, we do our best to keep it simple because I mean, you're not like running a multi-billion-dollar hedge fund where you need some of the really sophisticated like things that you need to know. For yourself, keep it simple so it's easier to keep track of. It's easier to take action when things are simple as well. We're easier to remember. So I kind of like want to just invest in 10, 15, 20 stocks, thereabouts. Uh, maybe 10 in Singapore for dividends, maybe 10 in the US for growth. A lot of Singaporeans do that as well. Dividends in Singapore because it's tax-free here, and then growth in the US because they're the best companies around. And I think between 15 to 20 stocks, that's kind of like the limit of how much you can keep track of your investments, because you kind of still want to know what's happening with, let's say, Google 6 months from now, a year from now. It's not easy to keep track of so many companies. So 15 to 20, it's good enough. And there's research that's been shown that around that number, you kind of minimize your non-market risk as well. So if I'm looking at, let's just start with 10 stocks, right? I mean, you don't have to invest in 20 stocks straight away. You got to build it up over time. So let's say I'm looking for 10 first, I have $100,000. If I'm diversifying across 10, I'll just position size it equally, and just allocate $10,000 to my first investment in the company that I like. And then if I find another company that passes all my criteria, then I'll put another $10,000. And over time, I'll build it up to $100,000. Of course, you're saving along the way as well. Your 10% will grow, and then you invest when the opportunity presents itself. I mean, you don't just jump in. Oh, I got money to invest, then I'll just throw it in, right? You want to wait for a good time as well. It's always handy to have a war chest of money set aside because you never know when a crisis could happen, like in COVID last year. So it was and I think one of the saddest things that could happen is that COVID-19 or something like that happens. You know it's a crisis. You know it's time to buy, and then you don't have the cash to go buy anything. So you don't want to be stuck in that situation. So make sure you save up, and then deploy when the time is right.
So as a rule of thumb, you're saying like 10 local stocks for dividends, 10 stocks in the US for growth. And you mentioned China just now. So do you look at China and or other emerging industries?
Yeah.
Emerging
So
markets?
I mean, yeah. So I mean that works for me. Some people could, they're a bit more, they want a bit more growth. They could put a bit more in growth, 70% in growth, 30% in dividends. Some are entirely in growth. And yeah, China is one market we're looking at as well. We can't deny that that's going to be the biggest economy in time to come. So China is very interesting. They have their own ecosystem that's very separate from the West, right? They have their own search engine, they have their own payment systems, their own credit cards, and all that. So it takes a little bit more time to understand this unique landscape that they have. And of course, you need to, not everything is in English as well. Of course, the big companies will have their annual reports in English and all that stuff. Um, but yeah, China is another place that we look at. So of course, we go for the very obvious companies there as well, like Alibaba, Tencent, stuff like that. And then we invest when the price is right. You can't really go wrong with big investments like that, big companies like that. And there's still a lot more growth to come in China as well. But then once you get really, you kind of like want to go to another layer and try to find those mid-sized companies that you think are going to next big thing in China. You need a little bit more experience because it's a market that maybe you're not as familiar with compared to the US, because a lot of US companies they're kind of global as well. Right? Their products and services are something that you interact with. Maybe not so with some of the China products and services, unless you kind of have a connection to China in some way. So yeah, we do look at China as well.
Okay, so to kind of sum it all up, like what's your take on portfolio sizing? Because you mentioned local stocks, US stocks, and you need to have a war chest when there's an opportunity to invest, right? Like how much you allocate to your war chest so that you're ready. Like, of course, it
Yeah.
depends on the individual investor, but
Mhm.
what's your take?
I would just, if you're just starting out, I mean, if you're advanced and seasoned, you kind of have your own strategy already. I don't have to tell you what to do. But if you're starting out, I would say just allocate things equally. So don't go big on one company just because you think it's going to be the next big thing. What if it goes wrong, right? And that can happen. So a lot of times I see people with, let's say they love Tesla. Tesla is a great stock. I think it's a great car company. I love Tesla. If I drove a Tesla in the US, I think it's the best car around. Okay, but Tesla as an investment is a different thing, and you have to be aware of the risks if you want to invest in Tesla, right? For example, so if you're going to put a lot of money in Tesla, in yeah, it could be the next big thing. But what if something happens to Elon Musk? Touch wood. A lot of the vision of where the company is going is because of him, right? So there's a huge key man risk in that, for example, that you need to consider. So I don't like to take that sort of risk. I kind of like to just allocate my positions like equally. Maybe some of my favorite stocks I put a little bit more, but in general, if I'm starting out, I would just put it equally, save up money every day, and then just build up your portfolio as you gain more experience, as you start to buy more stocks when the opportunity presents itself.
Okay, could you share with us some of the metrics you're looking at? I mean, is it like price to earnings, price to sales? You mentioned some of these things just now. Maybe we can go in depth using another example of a company that you've invested in.
Yeah, sure. Let's use Amazon. Okay, so Amazon, again, another huge pandemic stock. And I want to remind people that financials are not that important. Okay, they're important because it gives you a track record of how this company is doing, but the business comes first. So you need to understand the business because once you understand the business, how they make its money, then the financials make sense. Because if you just kind of look at the financials and say, oh, look, everything looks pretty nice, but you don't really know how they accomplish that, you don't really understand the business. So when you don't know the business well enough, and then let's say the stock price crashes 20% the next day, you're going to get a huge emotional reaction just because you don't know what's happening. But if you know the business well enough and the prices come down 10, 20%, you know exactly what you need to do. You can look at that, what the situation that's happening. Maybe, for example, Facebook, right? When I think the Cambridge Analytica scandal happened, I think it was 3 years ago, I think. Uh, if you were familiar with Facebook at that point in time, you knew that this was very likely a temporary thing. There's no other replacement for Facebook at this point in time. They own Instagram as well. The only competitor that they had was Snapchat, right? And it's not that big. So the price went down. I think it was I think up to I think 30, 40%. I think if I can't remember. Uh, and if you didn't understand Facebook and you saw that crash in share price, you could just get really scared and just sell at the wrong time. But that was a great time to buy, which is what we did at that point in time as well. So the business is really important. So once you understand the business, you look at the numbers, and then the numbers kind of make sense. That okay, so I know how this business generates all these financial results. So back to the question, which is about so what do we look at when it comes to financials? So pretty much the obvious things that anyone also looks at. We look at revenue. There must be growing revenue. We want to make sure we want to see that this company is serving a bigger market as time goes by. So growing revenue. You want to see profit, of course, and then not just profit but cash flow. So a lot of companies could be profitable, but they're not generating cash. And if that's like Grab and Uber, right, for example. So if they're burning cash, then that means they have to top up that cash from somewhere else, either through loans or from issuing new shares, which means that you get diluted as well. So eventually you can't burn cash forever. The company needs to generate cash. So cash flow is very important. The other thing we look at is debt. So obviously debt is good in the sense that if you have a good amount of debt, then you're using other people's money to grow the business, right? Then your returns are higher. But too much debt is risky because if anything happens, interest rates spike or there's a liquidity issue like in the 2008 crisis, then debt is a risky thing. So you want to make sure the amount of debt is relative, is good relative to the amount of cash flow that the company is generating every single day, the amount of cash and assets that they have on in the balance sheet as well. So the debt is important. We look at ROE, so we want to see how efficient the company is at generating profit from the amount of equity that they have. So usually the best businesses like Amazon, they have very high ROE of about 30%, which is actually really, really good. What else? Let me see. Look at cash conversion cycles as well. So these are the main things that we look at, and then that just kind of gives us an insight into. It's a great way to filter companies, but at the end of the day, like I said, you need to understand the business before you invest in anything.
So these companies that you've mentioned, I mean, they're great companies, right? And so some people might find current prices too high. And of course, whether prices are too high or too low, it's relative to the business performance and its fundamentals. But some people will be looking at it and, wow, okay, they have recovered since 2020. And now like it's looking quite high right now. So are you like waiting, or are you dollar cost averaging? What's your strategy right now?
Yeah, when it comes to individual stocks, I wouldn't dollar cost average because it's different. It's a different strategy. Like you could dollar cost average for the index, right? Over the long term, the index tends to rise, and then the index is kind of like a self-selecting. There's a self-selection bias as well. If a company isn't doing well, it's replaced by the next best company. So the index as a whole tends to rise, and you can kind of use a DCA strategy for the index. When it comes to individual company, there's no such guarantee that a company will always rise in the long term. Things. Look at Nokia; they dominated mobile phones. Now they're not. They're just nowhere near anything, right? So things can change. Disruption can change. So I wouldn't dollar cost average in general for individual stocks. So I'll look for the right price, the right valuation to invest in. So let's go back to the example of Amazon. So right now Amazon is about 3,000 plus. Looks really expensive. If you invested during the pandemic when it first came out in March 2020, April, I think you could have gotten about 1,007, 1,008. So it's about double. It's almost double in price. So Amazon looks really expensive, right? But you have to remember that you're just looking at prices, and prices in itself don't really mean a lot. It's just, yeah, the company has gotten more expensive, but it has also gotten more valuable as well, which is why the share price has gone up, all things equal. Okay, so Amazon at this price is actually still, in my opinion, fairly valued. If you take a look at their long-term price to cash flow, okay, it's about 24 right now, I think. And if you compare it to its like 10-year average, is thereabouts. It's not that expensive. So even though the share price has gone up to about 3,000 plus, in terms of valuation based on price to cash flow, it's still pretty reasonable. And the reason for that is because Amazon has grown its cash flow over the last 1-2 years as well. So it generates more cash flow. It's more valuable as a company. Share price has gone up, but it's still, still reasonably priced, if you understand what I mean. Yeah.
Right. And because it's Amazon, it's COVID, people are shopping online. And so like they kind of benefited from it as well.
Yeah, and I have to point out that when it comes to Amazon, a lot of people think it's just e-commerce. All right. So if you take a look at Amazon's revenue, e-commerce forms about, I think, 89% of the total revenue. So people look at e-commerce and they think that, yeah, that's Amazon's business. But they have another segment called AWS. I think some of you may know it. So it's like in the cloud business. So Amazon is actually the first mover in public cloud, in the public cloud industry. So if you look at the revenue, their cloud business only generates about 11% of revenue. So it looks like a really small business. But when you look at the operating income of Amazon, the cloud business actually generates about almost half of its operating income. So it's a lot more profitable than its e-commerce business. And yes, e-commerce is here to stay. Amazon is the biggest player in the market. But when it comes to cloud, it's a lot more scalable. It's a big business. The profit margins are a lot higher because you're not dealing with physical products. You have to build the data centers and all that. That's expensive, but it as a service as a public cloud service, it's a lot. The profit margin is a lot higher, and there's a lot more growth in the cloud industry as well. And if you look at your lifestyle nowadays everything is in the cloud, and it's not just talking. We're not just talking about photos and documents that you store in the cloud. That's just from a consumer point of view. When it comes to business like processes and their and their infrastructure, everything is going to be housed or is housed on the cloud because it's a lot more secure. It's a lot more powerful. It's a lot cheaper as well, rather than just building your own data center or building your own server room, which you need to upgrade every few years. You need to run a team of technicians just to handle all of that. Nowadays, you can just outsource that to the cloud, and they do things a lot better, a lot cheaper than what you could do. So the cloud is here to stay, and Amazon is the number one player in the cloud business. So it's not just e-commerce; they're in cloud as well. So the runway for Amazon is still, I think there's still some ways to go.
Okay, so we talked about Google, we talked about Amazon, we also touched a bit on Facebook. Let's go a bit broader. Let's talk about the markets in general, and let's divide it by local and the US. Like, what's your take on where it's going, on the trends? Like, what do you see?
I think it's pretty much the same. I think every country is facing the same question, which is when are borders going to be opened? And when borders are open, then you can expect the economy to open up as well. So that is the main thing that you're looking at for the next 6 months to a year. When is everything going to open up? So I think even as personally, as people just wanting to go out to eat, right? When is everything going to just be open up? So that's the main thing you want to look at when it comes to Singapore, the US. I think China's doing all right already. So yeah, when are things going to open up? So a lot of things will depend on vaccination rates and how well these countries are vaccinating. We're doing a pretty okay job, I think. The US is doing pretty well in vaccination as well, the UK too. So when vaccination rates hit a certain level, and I think once the R value goes down below 1, right, something like that, you can expect governments to go, okay, I think there's enough herd immunity, enough people are vaccinated, we can open up the economy. And those are things you want to look out for in the next 6 to 12 months in Singapore and in the major economies around the world. But of course, I have to remind you that a lot of these things are also priced in some of the stocks as well, because they really expect these things to happen in the next year or so.
Speaking of which, are you looking at stocks in the medical sector?
Medical sector, I think at this point we are not looking at it. We've been long-time investors in Parkway Life REIT. That's a very, very stable REIT in Singapore. Been following them for the last 5-6 years, attending the AGM almost every year. So not at this point. I think the opportunity was maybe a year ago. But even back then, we were looking at more of the growth companies as well, because the opportunity was a lot bigger, to invest in an Amazon or the Facebook or Google rather than a medical stock, which you need a bit of expertise or experience as well, because you need to be familiar with the industry that you're in. So REITs are pretty simple to understand because it's just property, right? It's like rental income and stuff like that. Another one we're looking at is actually CapitaLand. So CapitaLand is in Singapore, right? So it's going to restructure its business. They're going to run a EGM in, I think, the third quarter of this year. And they're going to restructure the business. They're going to take their development arm and make that private. And then what's left is a fund management business for their REITs and the properties that they manage. So when that happens, the value of CapitaLand could increase, because there's a lot more predictability to their revenue. Because in a property developer, it's kind of lumpy. You have a project, then you make money, but if it doesn't, it goes down. It's a very lumpy kind of business model. But that's taken private. What's left is more stable. So the investors could like that. So it could the value of CapitaLand could increase. So we're looking at that, but we are waiting for more details to come in before we decide. So there's another thing that we're looking at. And in fact, we did a roundtable on CapitaLand, I think a few weeks back as well. So you can check out our YouTube channel. We do discuss CapitaLand there as well.
Okay, we have about 10 minutes. So if you are watching this video right now, feel free to leave questions in the comments. I want to take this time to take it back to the fifth person. So you've conducted training for many people. Like, what do you think is the biggest challenge that your students face when it comes to investing? Is it more of a mindset? Is it more of a strategy? Like, what do you think is the biggest challenge that they are facing?
I think it's two things. Number one is knowledge. So you need to learn how to invest. So like I said, if you don't have that mindset already that you're investing in a business, you need to learn that perspective and invest in a business. Once you learn that and you have all that knowledge about how you should invest, the next step is actually taking action. Some people they learn a lot of things, but they don't invest, they just don't take action. So you need to take action. So a great example would be during the crash last year. Did you take action and buy during the pandemic? And I like to think that a lot of people actually did, because during that period, a lot of people actually opened brokerage accounts in March and April because we were tracking some of the affiliate offers that we were doing. So a lot of people were opening up brokerage accounts as well. So I think a lot of people are becoming more savvy nowadays and they are taking action. So I think these are the two things that you need to look out for: your knowledge, and then once you have that knowledge, you must take action instead of just sitting on the sidelines waiting for the biggest crash of all time before you move. You don't have to do that. Yeah.
Okay. And how about, I guess the way I also look at your journey compared to maybe my journey up to this point, right, is it seems like you had a group of people that you went on this journey with, right? Whereas I feel like for me, anyway, and I think for most other individuals, investing is more of it tends to be very lonely, right? Do you have any suggestions or how someone can navigate that whole scenario?
Yeah, join our courses in our community. So I think that's one of the issues that we solve as well. Yes, investing can be lonely, especially if your friends or your family, they're just not interested in investing. But if you join, I mean, it doesn't have to be us. There's so many other um, educational providers out there as well. If you like someone or what they offer, and if they provide a good community that you can interact with, I think that's very, very valuable as well, because then you can kind of like bounce ideas, kind of get to stay in touch with what's happening if you're too busy yourself. And a lot of times when the members join us, it's not just about learning the steps and the framework. That's just step one. A lot of times, those that stay with us, they they upgrade themselves and they join our community where we stay in touch with them. We run regular webinars telling them what's happening. We chat with them through a webinar like this, and they kind of stay updated with what we're looking at. And that keeps them in touch with the market, the good investments that we're looking at. And so you're not so lonely. You're not doing it by yourself. So you have someone to bounce ideas off with. We provide after course support. There's a Q&A segment that you can always ask questions anytime you want. Whenever people send us emails and they want to learn some stuff, we email them as well. So there's a connection that's always going on. They're not alone. So this is, I mean, that's besides the stuff that we teach. I think that's the other thing that we have that's very valuable if you're looking for a community to join to learn how to invest and stay invested.
Yeah, because for me, I would think that the community aspect is one of the key things, right? Especially if you're going through like your first like COVID type of experience yourself, you don't know what's happening, right? But the moment you have a group of people who's kind of been there, who can kind of say, hey, don't worry, your business is still fundamentally sound, right? Just help, walk people off the metaphorical ledge here before they, panic sell, right? I think that's a huge leg up between running it or doing something through a community and trying to do it yourself.
Yep, that's true.
Yep. Sometimes the side effect of that is that like your friends are sharing all the interesting stocks and you're like FOMO, fear of missing out, right? And so, but we have limited resources. So how do you balance that though?
Yeah, that's why it's so important to understand the business. Like, go back again. If you see your friends saying, "Oh, I made 20% last night. I made 100% last month," and it's easy to feel FOMO, and then you kind of wonder, "Wow, shit, man, I should have just bought that stuff. I could have bought Dogecoin or stuff like that, right?" But then, once again, when you make money, everything's hunky dory. But when things crash and you don't understand the investment that you bought, you just bought it because your friend bought it. You're gonna get a huge emotional reaction. You're gonna panic. You're not sure what you can do. You could end up losing money because you have no idea what's happening. But again, if you understand the business and why you're buying this business, it really doesn't matter to you whether prices go down, go up. You know that over the long term, the odds are going to be in my favor, and I just want to hold on to this great assets that's going to appreciate in value over time. That's it.
Okay, I have a fun question. So at the start of this live stream, I mentioned that I last interviewed Adam 15 years ago, and that was because like I was profiling him as one of the young successful people to interview. And one of the questions was like, tell us something interesting about yourself. Tell us a fun fact about yourself. Do you still remember your answer back then?
No, I don't.
Let me reveal it to you. You said you could bench over 200 pounds.
Oh, I can still do that.
You can still do that. Yeah, that was my question. Like, you could still do that. Also, you've been
I guess.
keeping up with the trading, even though with kids, and your business.
Yeah. So this
Wow.
lockdown has been such a bummer because you just can't go to the gym. So I tried working out at home. It's just not the same. But yeah, I can still bench over 200 pounds.
Still keeping fit.
Yeah.
Wow, that's amazing. I must ask, like, what's your typical day like? Like, what structure do you have to kind of make sure you take care of your body, take care of your family, and at the same time still do well in your business and your own investing? Because I feel like you're juggling a lot of balls in this sense.
Yeah, this is a good question. So I think the answer to that is actually I don't have a lot of things on my plate. I mean, I do have things on my plate. Okay, I get busy at times, but there are only a few areas in my life that I focus on. So my family, my friends, so my relationships are important. Kids, I spend time with them every day. My family and family, not friends. Friends are maybe once a week or something. Then I go to the gym maybe once or twice a week. That's it. I'm not like a gym rat. I'm not in every morning, stuff like that. I think for my lifestyle, what I'm happy with once or twice a week is good. And the rest of the time is just work. So it's actually just three things. There's nothing else I focus on that much. I don't have like maybe I play a video game, maybe I go cycling with my friends for fun, or play a game of tennis or football. But that's pretty much it. The focus on my life is my relationships, my career, which is my investing as well, and my health. That's it.
So it's like your investing philosophy is part of a life philosophy to kind of pare down everything to its essentials. Yeah. You don't get distracted. You know your style, you know your strategies, and these are the most important things to you.
Yeah, that's it. So I just kind of like to chill. So just focus on the big stuff.
That's right. As compared to like your partners who might be looking deep into company report or like analysis, but that's not your thing, so you don't look at that. And so same goes for your life, right? Like like your kids, your family, your business, and then like you don't look at anything else.
I mean, I look at the reports myself as well, so I have to understand the annual reports, the quarterly reports of the businesses that I follow, because I have to report that for our members as well. So I'm in charge of a range of companies as well. But yeah, some of my partners are into really digging into the companies and all that. So they enjoy doing that, and they have a lot more interest in doing all these things. So they do that. So for me, I'm kind of more that's not my style, and it still works. So there's no one size fits all way to be successful at investing or anything else in life, actually. Yeah.
And that is how not to look at your phone every day to check the prices, right? Because you really know what's important. Something for me and Chong Su to take note of.
Yeah.
I mean, if you give, there's no point. Unless you really, there's a particular play that you're focusing on, there's something there's some situation you need to watch out for. Okay, yeah, you kind of look and monitor it. But if you have a horizon of 5-10 years, what happens day to day doesn't really matter. Yeah.
Okay. Adam's kind of zen, right? like he's got everything under control. Yeah.
I try to. No, it's not. I try to. Not all the time, but yeah, if I feel like I need to just kind of like switch myself off for a while, I do meditate. And my wife tells me to meditate as well because she meditates almost every day, actually.
Oh wow. Okay.
Yeah, and I tell her, yeah, I meditate as well. I just do it 8 hours every night. So. But yeah, so yeah, I do meditate once in a while. Yeah, but I wish I had the discipline to do it more, actually. So yeah, something on my list to get better at.
Yeah. Well, you can always go force yourself into a 10-day silent retreat.
My wife actually suggested that. So they say at the first, second, third day, you kind of like break down. Emotions start coming up and all that. But yeah, I mean, that's not the focus of this discussion. But yeah, maybe one day. Maybe one day.
Yeah.
Right. Okay.
Well then, thank you so much, Adam, for joining us today and for sharing so many great tidbits and insights. Is there any last words that you want to tell the audience before we close it off here?
Thank you for, spending the time with us today. Time is precious. So the fact that you spent the last hour with us, I think it's a great honor, and I'm happy to be here. So I'm just glad to share my experiences, and I hope that that what I've learned and what I've shared can help you along the way as well. Yeah.
Perfect. Thanks so much, Adam, for your time. And for those who are interested in learning more about Adam or the Fifth Person, you can check them out at fifthperson.com, not the no D.
No, it still redirects there. It's the same.
Oh, does it? You have both. You have both URLs.
Yeah.
Okay. Nice.
Yeah.
So links in the description, and I'll also, I think Adam mentioned this earlier. So they are actually launching one of their investing programs. Which one was it, Adam?
Investment Quadrant. So launching next Monday. Yeah, focuses on pretty much what we've been discussing the last hour or so, finding great businesses to invest in the US and in Asia. So that course pretty much gives you the entire framework of what we do from A to Z, of how we go about looking at the business, the management, the financials that we look out for, and the valuation as well. So that's what the course is all about.
Yeah. And so if you're interested in learning more about that, or want to just get a little class and where he does go a little deeper, feel free to check it out. The link is in the description. We are working with them to promote this course, so there are a few little bonuses from the Financial Coconut as well. So check it out if that's of interest to you. And besides that, have yourself a great evening. Thank you for joining us for the last few weeks of this TFC Daily, and we hope to see you in person soon. Take care, guys.
See ya.